Dear all, MeDirect thanks you for joining this webinar, the 14th in our MeDirect Talk series, the second one for this year. During these sessions, as you well know, we do feature several financial experts and asset managers sharing their views on markets and investment opportunities. MeDirect has always been at the forefront of providing you with the latest on the investment world, and we aim to continue doing so through our regular updates on our website and social media and these talks. Our team of experienced wealth advisors are always available to assist you should you need any help. Today with us, we have the co-managers of Liontrust High Yield Bond Fund. Liontrust Asset Management is a specialist fund management company that takes pride in having a distinct culture and approach to running money. The company launched in 1995 and was listed on the London Stock Exchange in 1999. Liontrust are an independent business with no corporate parent, with their head office being on the Strand in London and also having offices in Edinburgh and Luxembourg. Today, we wanted to address the current geopolitical tensions that we as investors are actually facing. What do the latest developments in the ongoing Russia-Ukraine war indicate for global economies and markets in general? Donald Philips and Phil Milburn will give their insights on this and also discuss the energy price rises, inflation outlook, and central bank sections, with a particular focus on the global high-yield bond market. Towards the end of this webinar, Donald and Phil will be answering any questions you might have, so please do feel free to ask your questions as we go along with the discussion. We'll now leave the floor to James, Head of International Sales at Liontrust, for his introduction.
Well, thank you very much, Ingrid, and good evening, ladies and gentlemen. As Ingrid said, my name is James Bedall. I'm responsible for the distribution of Liontrust funds outside of the United Kingdom, and we're absolutely delighted to be presenting to you this evening at what is quite a difficult time in global markets, be they equity or fixed income. There's not much going up unless it's commodity related, but we do think that there's a keen message to be relayed to everyone tonight with regards to the high yield bond market, but also with regards to our views on the geopolitical tensions and worries around inflation and central bank action that is taking place as we speak. I'm going to just take you through a few risk slides, which are mandatory. So please take the time to read that. That's the first one. And if you wouldn't mind taking the time to read this, that is the second one. And now we can move on to the agenda, which Ingrid has already touched upon. So I'm delighted to be joined by Phil and Donald, who hopefully many of you, definitely Donald, will have seen either in the flesh at the events we've done with Ingrid and her colleagues on the ground in Malta, or the last MeDirect talk that we did, which I believe was at some point last year. So you know we are at a rather key point in markets. It's a very good time to be having the discussion that we're going to have tonight. There's quite a lot of information in the following 20 slides. Phil's going to kick off with a sort of macro overview and geopolitical update, which was going to lead into our outlook on inflation and what the central banks are doing to I think react is the right word to the current environment, because they've not been very proactive leading into it, and that may be one of the points I'm sure that Phil will address and that Donald will touch upon. Then clearly we're going to move on to talk about the high yield bond market and take the fund and take any questions that you may have. You should be able to ask your questions electronically via the panel in front of you. We will see them as they come in. We will not deal with them as they come in. There will be a Q&A session at the end, which I will host. We will turn our cameras on at that point so you can see us, and then I will hand back to Ingrid for a final conclusion to the evening. So pour yourself a drink, sit back, and please do enjoy the following sort of 35 to 40 minutes. I'm going to hand over now to Phil Milburn, the co-head of our global fixed income team, along with Donald, who's going to kick off with our outlook. Over to you, Phil. And don't forget to turn the mute off your phone. Or off your
it was just stalled. So good evening, everybody. As James said, there's a huge amount of interesting and conflicting forces impacting markets at the moment. And when we were looking to put together a presentation tonight for MeDirect, there were so many things we could choose between, and Ingrid helped narrow it down to the topics of most interest. So where should we start? There's an obvious place to start, and that's Putin's war. And I call it Putin's war because I don't want to blame all of Russia for its leader basically going out and stroking his own ego, trying to reassemble the Soviet Union. It's very much Putin, not Russia, leading this. But what has been the impact of that? Well, it's clearly increased tension around the world. And looking around the world, and I'm not going to go through every single country, but most in the West have obviously condemned Russia. When you look at the United Nations votes, though, countries like India and Pakistan have abstained. Why is that? Because they both want weapons supply from Russia, and they're worried about rattling the bear. But the biggest and the most important kingmaker, I would say, is China. China and Russia are allies, and basically, President Xi has his own agenda as he ultimately wants his third term, which needs a change in Chinese law. And so he's trying to play political games at the same time. What is his real aim? Ultimately, just to source commodities more cheaply for China. But they talk a tough game, they being the Chinese political side of it. But ultimately, most Chinese companies are still obeying the Western-based sanctions on Russia. And this slide is really to show you why that is the case. There might be a lot of talk, but from the economic perspective, the sanctions are being obeyed. And really, it's the pie chart that first shows this, of the trade between China and the US plus US allies, defined with a tiny little star there, is 3/4 of China's trade, whereas with Russia, it's 2%. It's a rounding error. That 2% will be increasing in the next few years, particularly Russian exports of discounted energy, but that's clever, not necessarily kind, but clever politics from Xi. But there's been a lot of talk about deglobalization because of this. And one thing we are certain about is the peace dividend, that sort of we can all live safely and spend more. A lot of that is gone, and you've seen that with even Germany now committing to spend 2% of GDP on defence spending. But are we going to break up into regional areas which all just trade with each other, US and Europe trade with each other and no one else? The answer is no, and that's in the bar chart on the bottom left. Just putting the scale of Russia, China, India's trade in total with each other is still less than the size of Australian imports or exports. It's still a global world, but what has happened is there's been a plateauing in globalization. And ultimately, this is one inflationary force because globalization has been disinflationary. But this is very much to say, deglobalization, no, just a pause in globalization. But what about the impact on commodity prices? Moving on to slide 10 to cover this. This, to me, is a very important slide showing which countries will be hardest hit. Obviously, Russia and Ukraine and Belarus, for that matter, have some very important commodities. The most frequently focused one that people have been focusing on has been energy, so oil and gas. Wheat will be an issue later in the year, though, particularly if Ukraine has a bad harvest. The weather is not on our side either, with various droughts around the world. And so what this chart is showing is the percent of the consumer basket, or in this case, consumer price inflation baskets around the world that are made up of food. And you can see India, it's a large proportion of consumer spending. That's the gold bars, or energy, which is in green. And again, you can start to look towards those countries, and it tends to be developing market countries that are most exposed the continuing hikes in those prices. So the transmission mechanism from Putin's war is less about deglobalization, but more about continuing inflation with particular pockets in the oil prices we've seen and in, for example, wheat supply. Two quick other things to mention: platinum and palladium are important for example, catalytic converters, and neon could be pretty important because that's used in semiconductor production. No one's really talking about those at the moment. There's still enough supply globally, but the longer the war rolls on, the more that could become an issue. That's a quick digression for later on when we've had a few glasses of wine. But to move on to show what these impacts have now on the developed markets, and that's on the consumer response part 1. I'm waiting for my trusty helper who's kindly moved the slide on. This is actually, the chart on the left is some great work by Morgan Stanley to show the impact of the oil price doubling on consumption. And the most important bar here is 2/3 of the way down, it's real consumption. And the simple conclusion is, if the US oil price doubles, if the oil price doubles in the US, consumption will fall by 0.6% in the US. Now, the US is better positioned than most, being pretty much energy independent. They produce, they're actually a small net exporter nowadays, whereas Europe is clearly a big importer, and hence the roughly 250 billion euro programme the EU is looking at over the next couple of years to wean itself off the Russian energy supply. So the sensitivity to oil prices doubling will be far higher in Europe, but unfortunately I haven't found any data that I can properly refer to there, but this is to give you an initial ballpark. And why does the consumer matter so much? We'll come back to this a little later, but it is still the Western consumer that drives global economies, therefore asset prices, therefore what was going to happen to everybody's retirement pots, etc. So what we are seeing already in many Western economies is what I refer to as wallet share substitution. People are spending more on food and energy than necessities, so they have less to spend on doing the niceties of life, either buying a new car or going out for a nice meal or anything like that. But, and it's an important but, this war has come just after, as we're all very well aware, the COVID crisis. And during the COVID crisis, there was a huge amount of excess savings built up. Looking at the US alone, about 2.4 trillion of excess savings were developed during the crisis, partly as a result of furlough schemes, but mainly just because the consumer couldn't spend and was still earning. Now, the numbers vary around the world, but if you add it all up, you get to $7 or $8 trillion equivalent. That's the good news. And the even better news in the US is the US consumer is willing to spend it. And that's the chart in the top right, just showing when they can spend, they do spend, the savings rate starts to come down again. The disadvantage there is that all of that excess savings around the world tends to be concentrated in the higher socioeconomic demographics, so the richer parts of the economy, groups A to C rather than D and E. So what can people in groups D and E do to counter what's often been referred to as the cost of living crisis? And this is the second consumer response slide we have. And the real answer to this is wage inflation. What can you do if you've actually not got enough to spend? You can ask for more wages. And the chart on the left here is a bit of an odd measure. We made it up, but it's factually true. This is just looking at the number of job openings in the States, running at about 11 million, versus the number unemployed at about 5.5 million, with the labour force actually having shrunk because many over 55-year-olds have retired, shrinking what's known as the participation rate. So what we're seeing here is wage inflation picking up. to a rate of between 5 and 6% in the US as unemployment falls. For those that did economics back in the 80s or 90s, this is just a classic example of the Phillips curve, with labour supply being very short. For those that didn't do economics, it's just was a shortage of labour, and so wages are having to be higher to attract new staff. This is happening around the world. In Europe, though, there's more of a lag as there's more collective bargaining. So we'll start to see greater European wage inflation really in autumn this year and spring next year. Now, this wage inflation is very important because it's the biggest supply constraint at the moment, but it's also a big issue for central banks, something we'll come back to in about 2 minutes' time. But moving on to other supply constraints on the next slide. We were seeing an improvement in the supply side. We were seeing a decrease in delivery times, or basically improvements all round, after the great reopening post the COVID crisis. And one of the biggest issues, and this is why I mentioned neon earlier, has been a lack of supply of semiconductors, the chips that go in anything from phones to cars to anything else. Like I say, we've been seeing improvements, and we'd expected further improvements in the second half of this year. But there's been two obvious interruptions now. The first is Putin's war and the issues that has created, anything from around energy to people snaffling up agricultural supplies. And the second, but less focused on, is the fact that China is still pursuing a zero COVID strategy, meaning as soon as there's an outbreak, they have a lockdown, and that continues to create almost like a flashing neon light on-off impulse of bottlenecks every time they open or close. And so what we've seen around the world, and I've just chosen US data here, is production can pick up for a while, but what you really need to see is inventories pick up again, so that the producers are running a little less on the just-in-time nature and more being able to do a few weeks worth of supply without relying on imports or the global shipping industry. So supply will still be a constraint around the world. But having said that, the build-up in inventories is a double-edged sword, and I cover this briefly on the next slide. Here we're showing the constituents of US GDP. I use US partly because of the availability of data for many of these slides, and partly because it is still the biggest economy in the world. What we're showing here, the key bars to look at initially are the light blue bars on mainly the part on the right of US companies rebuilding stocks, both so they can produce more and sell to consumers more, should add almost 1% to US GDP this year and help cushion that A, supply chain crisis, and B, the impact of higher energy prices, etc. But the instant glance at this chart longer term shows you those green bars, and that's the most important part. Consumption, or personal consumption expenditure, as we've shown here, is about 70%, just under, of US GDP, or the US consumer is still the biggest driver of global GDP, the US consumer being bigger in its own right than the Chinese economy. So why have we shown this? It's a reminder that demand will still be strong, provided wage inflation stays high. And so therefore we get to the slightly sticky problem on the next slide of wage inflation has been high. And this is now starting to be the issue that central banks have woken up to. And it's this central banking, what we've called as pivot, a switch from being dovish, from not raising rates, to wanting to be hawkish, raising rates, tightening monetary policy. That's been the biggest driver for financial assets year to date. Obviously, there's a big wobble in February, March based on Putin, but the biggest driver for assets outside of the Ukraine, Belarus, Russia region is now global monetary policy. And what we really have here is an inflation problem that's been, to a large extent, made by central banks. There was a problem with energy prices, with consumer goods, with services already building before the war started, and it's a convenient excuse the central banks have used to blame the war. Central banks should have been raising rates to put the inflation genie back in the bottle about a year ago. And the reason for that is very simple. Of the COVID lockdowns were supply and demand constraint, but that demand was not permanently destroyed. It was just shifted in time. And now that that demand is there again, there is no need for ultra loose monetary policy for low rates. And so what we're showing here is that stickiness of inflation. There's various charts to look at, but I think I'll just focus on the top left one, showing that core goods, the grey bars, have been particularly high up to the beginning of what is now the forecast period, but will start to come down, particularly as the price of autos falls, as auto supply picks up, and as everyone stops buying second-hand cars because they're happy to commute in a bus, in public transport rather than share transport. They're happy to go back to sharing transport rather than being on their own. Food's a bit of a moving part, but we can always strip that out of core inflation and the energy price, the blue bars we know about, but services are picking up. US inflation data, though, has peaked. It peaked last month, 8.5%. This month, which was out earlier this week, was 8.3%, but it will slowly trend down. A lot of this is noise, but the US does have an inflation problem, probably of nearer 4%, not 8%. But that is still double the central bank's target. And it's certainly enough for it to start to become embedded in consumer expectations. And so we're in a comfortable position where central banks want enough wage inflation that the lower socioeconomic demographic groups can still heat their homes, can still afford to eat. So want enough wage inflation for that, but low enough wage inflation that it doesn't become an inflation spiral. Central banks can always cure any inflation spiral by raising rates too much. And this is now the market's fear that the central banks are going to have to engineer a recession. It's a bit too much now to go straight to that fear, because there's a long path between raising rates now, the level at which rates are going to get to, and the natural lags. But it's certainly one of the key fears driving financial markets. And this has been very much reflected in sovereign bonds. And I show this on the next slide. And this is going to be one of my favorite little stats for you. Through to the end of April this year, and credit to actually Deutsche Bank for this stat, I won't pretend I came up with it myself. It's the worst start to the year for US 10-year bonds since 1788. No, I didn't make that up. That is a genuine stat. It came pretty close in 1994, which is a famously bad year for bonds. And as you can see on the graph, what we've done here is tracked yields on the left-hand side with the green line since the start of this year, and in the gold line, comparing it to 1994, using the right-hand scale. Clearly yields were higher then, inflation was higher, but the starting point being different, but the movements are pretty similar. So that's the pretty bad news. There's been capital loss in the bond markets. There is good news though. And the good news I really show on the next slide is that a reasonable amount is starting to be priced into the market. Here, this needs just a little bit of explaining. What I'm showing are real yields. These are government bond yields minus the inflation break-evens that you observe in the market. So not current headline inflation, but the market expectations of inflation. Or for those that are of a technical nature, it is equivalent to the real yield on index-linked debt. What I'm showing on this chart is it's been a very bad time for bonds. The yield up has obviously created that capital loss, but at least we now have positive real yields. It means that savers can at least earn, all of the things being equal, a positive return. and sort of maintain their spending power over time. So when would sovereign bonds be a buy? Well, we think we probably need to go another 0.5% higher in yield before sovereign bonds become a buy. And I'll hand over to Donald in just a minute to talk about corporate bonds, which are far more attractive than sovereign bonds. But for us to get that 0.5% higher, one of two things can really happen. The first one is just that normal bonds have high yields, so US Treasury yields go from 3 to 3.5%, and that will be another capital loss for the bond market of about 3%, but at least gets you to a decent value. The other option, the other path, is that inflation expectations start to fall as people believe the central banks will start to squash inflation. And it is forecast by the markets, and it is considered by the Federal Reserve, that US interest rates are likely to go up at the next two meetings by 50 basis points, 0.5% each time, then another couple of times, possibly smaller after that, to finish this year somewhere in the 2 to 2.25%, 2.5% range. Bear in mind, at the start of the year, rates were zero-ish in the US. The US has a range of 0 to 0.25% at the start of the year. Similarly, in Europe, the forecasts at the moment, bear in mind, rates are currently minus 0.5%. Forecasts are that rates will finish this year in positive territory. So at least a couple of rate rises from the ECB, with even this week, Christine Lagarde guiding to she would probably back a rate rise in July. So bonds are already reflecting a lot of central bank tightening and a lot of the bad news. But I will now turn to Donald to talk about what is happening in the credit markets.
Thanks, Phil. So it has been an incredibly difficult year, not just for sovereign bonds with Phil and his 1778 statistic, but it's been an incredibly difficult start to the year for high yield bonds and indeed for equities. Now, this has largely been driven, in our view, by all of the 10-year Treasury yields, the equity market, the bond market, are all being driven by the same thing, and that's the reduction in liquidity into the market and the spectre, the potential for higher interest rates. Higher interest rates will make debt more expensive, which will perhaps lead some companies to not be able to afford their debt. And also, as Phil pointed out, higher interest rates may engineer a recession, which could lead to a spike in defaults. Now, defaults for long-term investors such as MeDirect, defaults are the only real way you can lose money in the high-yield market, unless your fund manager sells bonds at distressed prices, which is effectively the same thing as a default. Now, what this chart shows us is the amount of compensation that is available from bond yields for the risk of default. Now, there's lots of numbers here, but I'll put it in the simplest ways I can. For higher quality, high yield in both euro and in dollar, for double Bs and single B, color-coded in green, the amount of compensation that's available will even support returns in the worst historic rates of defaults. Ironically, lower quality high yield doesn't even compensate you for kind of average default outcome. That is why we, as managers, we're very happy with our quality bias at this point in the market. The high yield fund that you invest in has that quality bias, indeed, so does our strategic bond fund. What we've seen in the year to date in the high yield market is not so much the fear of recession being priced into the high yield market, because the most cyclical sectors, the most economically sensitive sectors are not necessarily those that are underperforming. We're seeing underperformance in, for example, telecom bonds, which are reasonably economically defensive. And what's really happening is that reduction in liquidity from central bankers, all of the bad sentiment that we're seeing across equities and high yield is leading to some strange dynamics, non-fundamentally driven dynamics. It is fear and flows that are driving the spread widening, not fundamentals. And that's why we can see such good valuation opportunities in higher quality bonds. And today this fund yields for euro-based investors in excess of 6%. We think that is an excellent value proposition for a higher quality high yield stance, higher quality high yield positioning of the fund. To put that into a little bit more historic context, this is the yield of the European high yield index, just to best capture the returns for euro-based investors. Now, the 6% yield today is just about in line with the long-term, the very long-term average. So that might not sound so exciting, but the market has been characterized by periods of extremely high and extremely low yields. For example, the market has only had a yield north of 6%. That's for euro investors, 24% of the time since the start of the last decade. So 12 years, it's only been north of 6% for that period of time. And I'd also add as well that the euro high yield market is significantly improved in quality. So you would expect a lower compensation for higher quality, but the market has in fact improved a lot. So we are now 2/3 BB rated in the European high yield market, and the proportion of triple Cs is reduced drastically down to less than 6%. So for that improved quality and really good yield starting point, we think high yield is an interesting proposition right now. And there's two parts to a yield. There's the government bond yield, which, as Phil has pointed out, has risen, the so-called risk-free. And then in a corporate bond yield, there's also the additional spread that you earn to compensate you for defaults. As I've touched on, higher quality bonds are often really good compensation for default risk. And if you look at the average spread over a very long period of time of around 515 basis points, 5.15%, over very long periods of time, the average is about 4%. So you're earning much in excess of average in terms of spread for lending to European high yield companies. So despite all the negativity there is in the world, the liquidity that's coming out of markets, the fundamental driver of returns for high yield companies are the companies repaying their debts. We have a portfolio of high quality high yield bonds. We have a large degree of confidence in the ability of those companies to continue to pay their debts, which means high yield bond funds should continue to be an excellent generator of income for our clients. As uncomfortable as this 5 months of drawdown has been, while the market comes to terms with a different financial and political reality, Phil and I are as confident as ever in the ability of the vast majority of the companies in our portfolio to service those debts and produce that 6% yield over the medium to long term. So on that, perhaps we can take a pause for any questions you might have.
So good evening, everybody. At this point, you should be able to see us. So very nice to see you. James here in Luxembourg. I think I'm going to co-host the questions with Ingrid. She'd quite like to ask one or two of the questions that we have. But perhaps, Ingrid, if you don't mind, we can't see you. Your camera doesn't appear to be working, but we know you're there. We will perhaps kick off with a question that I have probably for Phil, but Donald, feel free to chip in. Emerging markets, Chinese debt, real estate debt piles in China. What effects are the movements that are taking place in certain core EM markets having on global markets overall, or how are global markets impacting the EM investors out there? And we do like to point out at the moment we're not one of them.
I'll take the specific example of Chinese property, and then I'll maybe pass on to Phil to talk about maybe a more general kind of emerging market economic context.
Great.
But Chinese property debt has been a really interesting little kind of case study for us over the last couple of years. Back in 2020, in the summer of 2020, when we were all just coming out of that first lockdown period, risk markets really got back to normal quite quickly. If David Roberts was here, he'd be saying that's when interest rates should have started to be increased, because stock markets and risk assets got back to normal pretty fast, and there wasn't really that need for liquidity that's really caused some of the inflation we have today. And we looked at what was left in the market in July 2020, still yielding above 10%. And the vast majority of those bonds were oil. At that point, oil was probably still below $50, not at the $110 it is today. Who knew then where oil was going? Mining companies, so a similar commodity theme, and Chinese real estate companies. Now, if you know our process well, you know that we don't invest in cyclical themes in any great size, because in high yield bonds, you only ever get par back. You don't get to make multiples of your money that you do in equities. But if you get it wrong, you earn zero. And all of those companies in one sector will probably lose money at the same time. If the oil price goes to 20, all of the oil companies go bust. So we looked at Chinese real estate, and between Phil and I said, look, we don't understand these balance sheets. The transparency is really bad. We don't know anything about how Chinese real estate is managed from a political perspective. We shouldn't be going anywhere near this. So we left it alone. You fast forward a year and a half or so, all of these bonds were no longer yielding 10%. They're yielding 20, 25, 30%. And we looked at it again, but we came up with the same conclusion. Many of those bonds are issued out of Hong Kong, dollar bonds issued out of Hong Kong. There's a slight separation between the sort of Hong Kong debt issuing subsidiaries and the onshore domestic Chinese subsidiaries. We couldn't imagine Chinese taxpayers bailing out Hong Kong dollar investors, which has proven to be pretty much accurate. So we avoided it again last year. And now many of those bonds are trading at sort of 20, 30 cents on the dollar, which is huge upside. But in all likelihood is that debt will be restructured. It's the flip side is, if we'd invested in 2020 in oil companies, we would have made a lot more money for our clients. However, if you'd gone and bought an equities portfolio that invested in those same oil companies, you would have made a hell of a lot more money than we would have made you. So that kind of avoiding of cyclical themes in our portfolio, we think, serves us in good stead for being seduced by high yields in particular sectors at certain points in the cycle. So still no Chinese real estate exposure. And then maybe I'll pass over to Phil for a more general EM comment.
Thank you, Donald. Thank you, James. Normally, when the Fed raises rates, it causes a crisis somewhere in the world in emerging markets. The famous last words of most fund managers' careers are often, "It's different this time." So there are nuances, but it normally does cause a crisis. So, for example, I showed a chart earlier showing 1994, which actually helped cause the Mexican crisis. What has changed since, for example, the Asian crisis in 97, 98, is that EM has become less of a mass trading as one and very much more bottom up, each country doing their own thing. And certainly their external balances have improved because most sovereigns have learned to not do the emerging market country original sin, which is issuing too much debt in hard currency in the good times, then your currency devalues in the bad times, and you've got therefore more debt because it's in hard currency. So there's less of that around. And the other nuance in this cycle is most EM countries are ahead of the Fed in the rate rising cycle, have been trying to squash inflation and are therefore much further ahead. So most Latin American countries, most senior countries have already raised rates by normally quite a few percent. That's all good until really a month or two ago when the dollar really started strengthening. And that starts to put pressure on emerging markets. Emerging markets thrive most. Generally, it's mixed per commodity, but when commodity prices are high, activity is high, monetary policy is loose, and liquidity is loose. So you can see some of them unwinding. We will not be buying emerging market sovereigns in this fund. They are off-piste for us. That's not something we'd ever naturally buy. But this is just more out of interest to say there will be rich pickings excuse me, in emerging markets, but absolutely you have to stock pick rather than just generically buying any index.
Ingrid's on mute.
I think you're on mute, sorry.
Still on mute.
Okay, can you hear me now?
Yes.
Perfect. So we have another question that came in from the audience.
Yes.
So do you see a higher risk of default among European companies given that geographically they are so close to the ongoing war in Russia? It is clear that in terms of oil and gas as well as commodities, Europe is worse hit than obviously its counterparts. So do you feel you need to steer clear away from high-yield bonds offered by the European companies at this point in time? And do you currently have any such exposures which are getting you worried?
Yeah, I think that's a great question. Right to the heart of the matter in high yield, especially given I just showed you a chart of European high yield specifically. Our fund is a global high yield fund, but the reason I showed European high yield is I can show you the cleanest yield for European investors, but also we have a large overweight to European high yield bonds in our global high yield portfolio. So let me just, given the point of the question, I tend to agree with that European companies are more affected by the conflict, primarily in relation to energy costs. So, why then do we have that overweight in European high yield bonds? Well, first of all, we've looked in some detail, plenty of detail into the cost basis of the companies we lend to, and those headquartered in Europe that have a manufacturing base are primarily packaging companies that we lend to, and packaging companies often do have high gas costs, for example. Sorry, one. Sorry for that. So European companies have high gas costs, particularly packaging companies have this kind of cost. The great thing about packaging companies, particularly packaging companies we lend to, including Arda Packaging, they're not just European, they're global. Large parts of their manufacturing is in the US. US is a very internally served energy market. But in Europe, they also have pretty good pricing power. And the absolute key to investing in an inflationary environment is to invest in companies with decent pricing power. And what we're seeing is the packaging companies, maybe with a quarter or two of delay, passing on costs to their consumers. That's not great news for consumers, but it is better news for the margins of companies. Apart from packaging, we have very little really manufacturing-based companies in Europe. Very few cyclical companies in Europe. So generally, we are relaxed with the sort of stock picking in the portfolio. We are now. This is results season right now. Companies are in that period where they issue results. We're more than 90% of the way through results in the US. We're about 80% of the way through results in Europe. And generally, companies have been outperforming expectations. Results season has been solid. And we already know that corporate profitability is at a high base. It's higher than pre-pandemic, for example. So the hit that's coming in Q2, undoubtedly that's coming, will have a full period of higher costs. And as we're seeing in the UK, for example, signs of slowdown. So Q2 profitability will be lower, but companies are in good position to absorb that. So overall, we're really happy with the individual holdings that we have, and for Euro investors, the 6% yield that's on offer. For our US-based investors, that's well above 8% yield. And we think that's a level at which, once people get over this negative sentiment where we all think that the world's doomed and we're all going to go and live in a field with tin opener and a can of beans, once we get over this mindset that everything's awful, which we always do eventually, people will look at these high single-digit yields in the high yield market and think, this is attractive. And those spread valuations, those compensation for default valuations are more attractive in Europe than they are in US, and that's why we're overweight European bond issuers.
Thanks, Donald. Perhaps I can just ask a broader question, perhaps one for Phil, actually. I think, do you not feel that there are certain countries, I'm thinking of one in particular, which is very close to near where I live in Luxembourg, where the social impacts of higher inflation, obviously, inflation going up, prices going up, could end up being really extremely disruptive? Thinking of France notably and what they went through 3 years ago.
The good old Gilets jaunes, if
Gilets
murdering of the pronunciation. It's actually a factor around the world of the monetary bank policies since the financial crash of 07-08 have been partly about propping up asset prices and wealth, and have very much favoured the haves over the have-nots. And into this vacuum of hope for the have-nots have come the two extremes normally. It's the extreme left or the extreme right, populist policies. And you've seen this around the world. It's just the French have a national habit of being better at really protesting than most other countries. I'm an Englishman living in Scotland. Don't worry, I'm very cognizant of nationalities. But it is a natural phenomenon. And this is one of the reasons why it's a very tough tightrope now for all policymakers to walk along, of you need to let the lower socioeconomic demographic groups still maintain their real spending power in the face of an extreme cost of living crisis due to energy and food prices, because they've already had 12 to 13 years of the rich getting richer in relative terms. Now, in many economies, most economies actually, income inequality has actually got better in the last 10 or 15 years. Only a little bit, but a little bit better. But wealth inequality is out of proportion given, well, basically those that started with assets have had the advantage of that cheap money. So central banks will keep raising rates. Asset prices, well, hopefully they've seen most of the falls, but will they make sure the economies don't collapse? Because if they do, we have a really awkward melting pot of huge disaffected swathes of various countries that will look for a simple solution. That's all populism is, a simple solution that never works. Blame someone else. Hey, in the UK, we got Brexit, and that is economic stupidity. Whether it's political stupidity, who knows, but that's just economically bad. You're arguing against gravity. So what do we need to counter this? Well, a few things. There needs to be more redistributive policies around the world to stop populism growing. Again, these are political choices. And then the other part of the melting pot is the nature of media nowadays has changed so much, so that people are all seeing the news they want to see online rather than an unbiased factual truth. What does this mean for investment? It means you have to keep an eye out for populist leaders. And we mentioned EM a couple of minutes ago. A great example is Erdogan in Turkey is supported by populism, and yet his unconventional policy is that lower interest rates will support the lira. The lira is currently down in the last few months 45%. So that populist policy is making most Turkish people a lot poorer, and it's even constraining the banks, the financial system. So it's a risk we have to be aware of really when looking at countries and which companies based on which countries to invest in, is that populism never ends well. But unless we, the Western world, actually start to give redistributive policies, then by definition, populism will continue to grow. So I think that's a great question. Thank you, James, and something that should be on both economic and social policymakers' minds for the next few decades.
Thanks, Phil. Ingrid, do you want to ask the next one?
Yes. So during your talk, you did mention that you're very comfortable with the companies you're invested in, that you always choose good companies. So maybe you can run us a bit through what criteria you mainly look at to make sure that what you're investing in actually works in the long term.
Yeah, sure. I mean, the high yield market, we have a process that's designed to point us in the direction of high quality companies. Any high yield manager over the course of long term will have a few bumps and scrapes along the way, and Phil and I have both got scars to show for it. But through a full economic cycle, we would expect to limit defaults in our portfolio through that quality bias. So how do we do that? First of all, we have a research framework called our PRISM, which is really it's very simple. It protections, risks, interest cover, which is another way of just saying financial analysis, sustainability and motivations are PRISM. The number one protection for any company is the quality of the business, its competitive edge, the structure of the industry. Also in corporate lending, you can have contractual improvement. So we look at the contractual details of a bond prospectus, but really it's the quality of the business. And Phil and I look for pricing power, market share, all these good things that when you get periods of inflation, means you can pass on those costs to your customer, which is unfortunate for the customers, but we're the ones that are lending money to them with your money. So we need to look for that. Risks is just a corollary of those. What are the key risks to any business? Its competitive edge, the industry structure. For interest cover, for financial analysis, Phil and I try our best to find listed companies where you have 20 years, 30 years, 40 years of data, and we can look back and see how previous economic cycles have impacted that business. In sustainability, we're using modern day kind of ESG factors to assess the quality of a business, but also, excuse the ambulance, but also in the world of lending, we're not shareholders. An ESG analysis might say, how are they protecting minority shareholders in this business? What do we care as lenders? That's stuff for the equity holders to think about. What we're looking for within ESG, within the governance part of ESG, is how the balance of interest between the owners, the managers, and the lenders to a business, how the balance of interest strikes. And if we find a situation where we think there's not a good balance of interest with us as creditors, we won't invest or if that balance has changed during our investment period, we'll disinvest. One example, recent example, has been a company that we've lent to for a number of years called Bausch Health. It's a pharmaceutical company, a healthcare company, and we kind of got a little bit blindsided by management who have sold off the best part of the business. It's the Bausch & Lomb eye care, very stable, very good credit type of business. They've sold that off, which is okay. It's within their rights to do that. But they're giving all that money to shareholders, and they're deliberately leaving what the business that's left with a much larger amount of debt than we'd be comfortable with. So we have reduced that position. Unfortunately, we didn't reduce that position fast enough. So, it's been a mark-to-market loss. We still have a small position in this. It's much smaller than it was, but it was an ESG, the last part of the prism in motivations. The motivations of the company appeared too greedy towards its shareholders, and we reduced that position accordingly. But it has cost clients in this downturn. Those bonds have sold off more than other bonds, and we'll continue to assess that ongoing position as we go. That's probably now the riskiest bond in the portfolio, one where it's a pretty good underlying business, but the motivations of management have made it a weaker credit than it was when we originally invested.
So I think Ingrid, we perhaps have time for one last question before the hour is up. Donald and Phil, you both, it's written in the presentation, so I can put it, you've been adding to your own personal holdings in the fund in recent days. So obviously think it's a fairly decent entry point. Two parts to this question, if you don't mind. You mentioned the yield for euro investors. I think that MeDirect possibly has quite a few sterling investors as well. If you wouldn't mind mentioning the yield for the sterling and the US dollar classes of the fund. And also just perhaps one quick word on if there were to be the wonderfully hopeful event of a sort of premature end to hostilities in the Ukraine. What do you think could be the knock-on effect for markets generally in the high yield market of that particular piece of macro news?
Well, the easy one would be that the US dollar yield is just north of 8%, and the UK GBP yield is about 7.75%, and then European yields lower still. But for us, that entry point for US investors at north of 8%. If you look back, the history of the higher market going back 30, 40 years, that has always been a fantastic entry. I mean, buying at 6% yield has always been a fantastic entry point because defaults have stayed low. And as Phil and I have pointed out, yes, we have inflation. Yes, we have trickier outlook than we've seen before, but we still ultimately think that in that good quality part of the high yield market, compensation outweighs default risk. So that's why we've been very happy to add. For me, not my job, but equities just feels too uncertain at this time. So just getting a reasonably confident medium to long term. I'm not saying that this is the low point of the market, but I'm confident that this is a good starting point of 7-8% yield. To me, is a good decision to add, and at 40 and late 40s, we've got plenty of time to earn out a little bit of volatility in the market.
If I can slightly add to that, mid to late 40s, thank you, Donald, in terms of my age. To James's question of what happens if the war suddenly stops, if Putin says, I've done enough, I've got a new Russian victory day, which obviously it was on Monday, fortunately didn't escalate then. The obvious thing is a lot of the risk premium comes out of the market. In high yield, the biggest risk part is the credit spread Donald talked about earlier. That dominates, and you've only got a little bit of sovereign yield down there. So the high yield market would rally, obviously all equity markets would rally. Looking through, what would it do? There'd be a double-edged sword for central banks. If you see a big fall in energy prices, which would take obviously down headline inflation, that's very good. But because of the confidence it should give to people around the world that this lingering Putin threat, it's not going away for a while, by the way, but if it was to happen, then it might give central banks, particularly if supply chains come back on stream, central banks the excuse to speed up the pace of rises. So a bit of a double-edged sword there, but net it would be very positive. So it'd be very positive for high yield, probably neutral for sovereign bonds because of the twin effect of headline inflation versus central banks, which means it's probably better. I'm going off-piste here, but I did start on equities. It would probably still be better for value equities than growth equities, but both would rise a lot as some of that fear and risk premium comes out of the market. But to say, have I been adding to high yield in the last few days? Personally, yes, I have. I echo Donald's sentiment of we aren't either clever or lucky enough to call absolute market bottoms, but we are certainly sensible enough to identify when an asset class is cheap and when to start long-term averaging into it.
Fabulous. Thank you, gents. Ingrid, I think that's the end of our part. Before I just quickly hand over to you, I'd like to thank everybody for joining us. But Ingrid's got a few more words to say. And if you thought Donald was acting strangely during that call, it's because he has his dog in the office with him. And I believe he was trying to let the dog in or out of the room. So thank you, and back to Ingrid for some
apologies for that. I would have just put him in a different room, but he then barks very loudly, so kept him under the desk and hoped he would be very silent. So
he actually did behave quite a lot.
Yeah, he did very well.
He did. So James, Donald, Phil, the whole team at Liontrust who actually put this together and helped us making it a success. Thank you for your time today. Thank you for all the information provided, and we hope that we will see you in Malta very, very soon. A big thank you also goes to all of you who have joined us today. Our team of advisors are available if you have any further questions with regards to the topics discussed today and any other topics. Further information also on the high yield bond fund can be found on our website, and we have Donald who actually does provide us with a quarterly update on this fund. So feel free to log on to our website, have a look at the articles, and we will continue keeping you updated. Thank you, everyone, and have a nice evening.
Thanks, Ingrid. Good evening.
Thank you.
Thank you.